Pode iniciar, João.
Bom dia. Vejo aqui já temos 12 pessoas. Muito bom. Bom dia a todos. Muito bom. Vamos lá. Muito obrigado a todos que compareceram aqui hoje. Meu nome é João Batista Ribeiro, acho que muitos de vocês já me conhecem. Eu sou parte da diretoria executiva do IBEF. Estou aqui hoje representando nossa presidente Magali. Magali está num outro evento, não pôde participar, mas pediu para agradecer a cada um de vocês que está se juntando a gente nessa live hoje. Esse é o segundo evento do ano. Acho que a gente já teve um evento muito importante no início aí de janeiro, para a turma que cuida de controladoria, que fala de demonstrações financeiras. Hoje nós vamos falar de um outro assunto muito importante também, que tem a ver com nosso planejamento do ano de 2025 e os próximos, né? Então, vamos falar um pouquinho dos fundamentos do Rating Soberano do Brasil. Nós vamos ter aqui um convidado muito importante hoje, vou deixar o Filippo apresentá-lo. Queria aproveitar também e agradecer aos nossos mantenedores. Cada dia mais nós temos mais empresas se juntando a gente, empresas de altíssimo nível, que nos deixa muito felizes, significa que o trabalho que a gente está fazendo está impactando, né? Queria agradecer aí ao Filippo por ter se disponibilizado para nos ajudar mediando esse evento de hoje. Muito obrigado, Filippo. Muito obrigado a Fitch e ao Todd, que está aqui hoje, né, para nos ajudar a entender melhor esse tema. E eu queria pedir a vocês que estão participando que mantenham os seus microfones aí fechados. Mande as suas perguntas para nós através do chat aqui. No final, o Filippo vai encaminhar as perguntas de vocês para o Todd, ok? Se você puder mover aí, Elane, eu queria falar que a gente tem mais um evento no IBF planejado. No dia 11 de fevereiro, nós vamos ter um evento do Conecta, que fala de Diversity and Inclusion, a importância disso. Eu sei que esse é um assunto que está muito aí debatido hoje por todas as ações que a gente vê acontecendo em algumas empresas, em alguns países, mas o entendimento nosso é que esse é um tema que continua extremamente relevante na agenda de todo mundo. Eu recomendo muito a participação de vocês. Temos aí 3 executivas que vão estar falando, representando 3 empresas que têm iniciativas muito interessantes nessa área. Eu queria que se vocês puderem mandar as perguntas de vocês já em inglês, né? O Todd vai fazer a apresentação dele hoje em inglês. Ele fala um português muito bom, mas ele preferiu, né, fazê-lo em inglês porque ele fica mais confortável. Então, acho que todos nós aqui podemos perfeitamente entendê-lo. Então, se você já puder mandar a sua pergunta em inglês, vai facilitar a vida do Filippo aí, ok? Filippo, nosso CFO do Fleury, membro ativo aí do IBEF. Muito obrigado. Floor is yours.
João, obrigado a você, IBEF, pelo convite de estar aqui. Acho que para nós todos, acho que é um prazer e um privilégio termos aqui o Todd Martinez conosco hoje nesse painel. O Todd, ele é diretor sênior e co-head das Américas na Fitch Ratings, portanto, tem aí uma conexão muito forte aqui no acompanhamento e no material que se prepara de respeito a Brasil, não é? E a gente tem aqui uma oportunidade, acho que hoje, de falar um pouco sobre como é que está sendo visto os fundamentos, efetivamente, o rating soberano de Brasil, tão importante para muitas empresas, que acaba conectando com toda a nossa rede aqui de mercados de capitais, não é? Então, como você falou, Todd vai fazer uma apresentação e nós teremos aí a oportunidade depois de interagir e responder algumas perguntas específicas. Então, vamos seguir desse jeito. Todd, please, it's up to you now. Please go ahead and welcome again.
Obrigado, Filippo. Obrigado, IBEF. Bom dia para todos. Vou mudar para inglês. Desculpa, só para me expressar melhor. But thank you so much for this invite. Yes, so I'm presenting on Brazil today. Look at the whole region as well. And I always preface my presentations by saying, Brazil is a big, very complicated country. I'm sure everyone in this call from Brazil probably knows the country and the economy quite a bit better than I do. But hopefully there's still some good insights in this presentation. And, want to give you an idea of how Brazil is viewed from the outside and how it compares to a lot of other major emerging markets in the world, and how we arrive at the credit rating, which is, we know, is a topic of interest to many. Brazil, uniquely in Latin America, is a country that does not rely on external borrowing, especially the government. But in some sense, that means that the investment grade and the rating might not be as interesting to people, but we're pleased that there's so much interest, and I'm happy to be here today. So give me one moment to open this presentation. Great. So Brazil's sovereign rating fundamentals and prospects. I'll speak about how we arrive at Brazil's rating, and I'll answer the question we often get on Brazil, which is, what does it take to get back to investment grade? Brazil is one of the few fallen angels, a country that had an investment grade rating and has lost it. And there are prospects for recovering that. I'll explain what that could take. So first of all, there's a lot on this slide, and I won't go into depth on every little element, but this is just an overview of our process for the sovereign credit ratings. There's kind of three sections here. The first one on the left is our starting point. We start off with a model, an economic model, where a bunch of variables go in. I think there's 19 variables on that list, a lot of obvious ones: debt to GDP, economic growth, international reserves of the central bank. About 19 variables that go into a model, and it produces an indicative rating, where the model predicts the sovereign rating should be. And interestingly, in Brazil, the model that we use predicts a BBB- rating for Brazil. That is the lowest level within investment grade, but it's an investment grade rating. So you can look on the left here and see in the chart, what are the variables in the model where Brazil looks the best, the variables that are helping Brazil's model score the most. And we'll talk a lot about these issues later in the presentation: fiscal variables, growth variables, external finances. But you can see that the top category, what we call the structural variables, are without a doubt what help Brazil score the most. The variable that helps the most is share in world GDP. Brazil is just simply a very large economy, and in our methodology, that is something that should help your sovereign credit rating. It might seem a little fair, but small countries, we think, are more vulnerable than bigger countries. And why might that be? Well, big countries are more diversified. Brazil's a great example of that. Bigger countries are less vulnerable to climate risk if they cover a wider territory. And big countries can often benefit from economies of scale, where due to their size, they're in a better position to develop deep capital markets. And I think Brazil is a fantastic example of that. Other than that, share our GDP per capita, how wealthy the economy is. Brazil's still developing, but it compares favorably to a lot of other countries. Those two variables I mentioned have the highest weight in our model. And then there's many other variables here that help Brazil or hurt it, but the ones that hurt it the most are clearly the public finances. Brazil has very high debt to GDP. It has especially high interest to revenues, the share of revenues that have to be dedicated towards interest payments on the debt. But then one of the variables that's very good for Brazil, as I mentioned earlier, is that Brazil does not rely on external financing. Brazil uniquely is a country that can finance a very large fiscal deficit entirely in its domestic market. So I'll stop there on the model, but I'll go to the second part, which is the part on the right, the qualitative overlay. We don't, simply just use a model to determine the sovereign credit ratings. If that were the case, I might not be needed. I might not have a job. The second part is very important. It's the qualitative overlay. We take a look at the model output, and just based on our understanding of the country, we decide if the model's not capturing something. And in the case of Brazil, we think we take away 2 notches from the rating. And one of those notches is, I would say they're both similar. One of them is related to the public finances. Even though Brazil's variables in the model for public finances are already weak, we think there's additional weaknesses that aren't captured, namely just how extremely rigid and indexed, earmarked Brazil's budget is. It makes it very hard for the government to have much flexibility. The tax burden is already quite high in Brazil. That also limits fiscal flexibility in our view. And then this -1 notch for the macro environment, we just see a lot of correlated risks in Brazil. You know, the fiscal situation is pressuring real interest rates. Right now it's pressuring inflation somewhat. And in the event of a growth slowdown, debt to GDP could be on a much more rapid path. So the correlation between a lot of the risks in Brazil and what they mean for the government finances is the source of another -1 notch. So in the middle, as you see, the model produces a BBB- rating. We take away 2 notches and we arrive at a BB rating with a stable outlook. And here's the history of Brazil's rating. As you can see here, the blue line is what the rating is, and the red line is what the model says it should be. So we've always had a rating that is below what our model indicates Brazil's rating should be. The model rating got as high as A- in those years when Brazil was having spectacular growth rates and the fiscal situation was quite a bit better. But the model score came down quite a bit when a lot of those variables deteriorated. And of course, the rating came down quite a bit. During Brazil's economic and political crisis in 2015 through 2017-18, we downgraded the rating by 4 notches total. There were 3 notches that came quite close together, and then 1 notch that came later in 2017, 2018, when there was a setback in the pension reform, which the government did ultimately pass. But a setback due to a lot of the Lava Jato and related issues in the Temer government. And then since then, Brazil has covered 1 of those 4 notches that it lost during its economic crisis. We raised Brazil's rating in 2023. And I'll get more into some of the reasons why we raised Brazil's credit rating, not because we thought the fiscal situation had been solved, but that we saw some progress in that regard over the prior 5 years, and because of other strengths that I'll get into in Brazil. So moving there, and I'm starting with the good stuff. What is surprised us positively in Brazil? And without a doubt, that's Brazil's economic growth. As you can see in the chart on the left, this blue line is what real GDP growth has been. It's still a projection for 2024. And was probably even a little bit better than our last projection of 3.1%. But the trend is clear. For the past 4 years, we've been widely underestimating Brazil's growth. I think coming out of the pandemic, that was something that happened in a lot of countries. We maybe just underestimated how quickly a lot of countries were going to rebound from the pandemic. But in Brazil, the trend has continued 4 years later. It seems like this recurring pattern where at the beginning of the year, we're estimating 1.5% growth for Brazil or up to 2%, and growth turns out being, closer to 3%. So that's been a very positive surprise in Brazil, and it's not been the case in a lot of other economies in Latin America. Mexico, the second biggest economy in Latin America, growth has disappointed us in the past year, whereas Brazil continues to be the big positive surprise. And as you can see on the right here, I've just shown how Brazil stands in a regional comparison. Brazil is the red line in the middle. And, all of these lines are showing economic activity of Latin American countries relative to where it was before the pandemic in 2019. And, Brazil is one of the top ones on the list there. This very top line is Central America, the CAFTA-DR bloc. Very impressive growth in Central American economies. I've put them together as a block here. But after that, there's Colombia, which maybe was overheating and has slowed in the past 2 years. But then there's Brazil, one of the economies that's had the best growth in the region, and it's also the biggest economy in the region. So that's been a fantastic surprise for Latin America as a whole. Better than Chile, Mexico, Uruguay, a very stable, politically stable place, but not growing as fast, and certainly than Argentina. So, the fact that Brazil entered the pandemic with many years of economic crisis and a fairly weak recovery, but the fact that it's regained this dynamism, has been a very positive development for us. So, this begs the question, is Brazil just a more dynamic economy than a lot of local economists and that we at Fitch are giving it credit for? We are still estimating, Brazil's medium-term growth will be 2% instead of 3%, which is a pretty low growth rate. Because I think right now it's not entirely clear to us if Brazil's economic outperformance has been a reflection of structural factors and economic reforms, or if it's been a reflection of policy stimulus. So on the left here, I've listed a bunch of reforms, and this is very good news in Brazil. Brazil is one of the few economies in Latin America, and the only major economy that's achieved some very important structural reforms in the past decade. This is just a list of the main ones, but there's been labor reform, a pension reform that was very difficult, independence of the central bank. Of course, this past year, we've seen a historic consumption tax reform. I'd also just add the shift from TJLP to TLP, changing the interest rate subsidy framework, has helped deepen this, or helps the capital market flourish. I've been extremely impressed this week, as I always am, with just the sophistication and the depth and innovation in Brazil's financial market. And that could be another thing that's supporting higher potential growth in Brazil. But that said, why are we not yet convinced that this means higher potential growth for Brazil? Well, Brazil is also one of the countries in the world, and in this middle chart, I'm showing the world's largest economies. Brazil's one of the countries that's had the largest fiscal impulse, which is a concept used by the IMF just to show how much in structural terms the fiscal position has deteriorated in the past 2 years. And Brazil's only second to Turkey for how much mostly additional spending there's been. Turkey, of course, is still recovering from a major earthquake. So Brazil has had a large fiscal impulse at a time where growth was already pretty good, and that, in our view, is probably explaining a lot of this economic outperformance that we're seeing in recent years. And it also means that a lot of the economic outperformance we're seeing is more consumption related. It's not being driven by significant growth in investment. There are some positive stories in investment, and it's above where it was in Brazil's crisis, but it's still a very, very low investment to GDP ratio, one of the lowest among major emerging markets. So, until that variable changes, we might not have full conviction in Brazil's growth potential being, higher than the 2% we currently estimate. But we recognize that, a lot of these reforms could be having a bigger impact or a faster impact than we previously expected. So I think by the end of this year or next year, if Brazil keeps surprising us and it's no longer a result of fiscal expansion, we might be more convinced that this really is a structural growth story rather than a cyclical one. And then moving on briefly, I think to another strength in Brazil, and a reason we upgraded Brazil in 2023 is we have a lot of confidence in Brazil's central bank. I think it's shown itself to be one of the most proactive and prudent central banks in the whole world during the inflation shock of recent years. That said, there's only so much the central bank can do with monetary policy, which is a very blunt instrument. And in the context of fiscal concerns and kind of global uncertainty and financial conditions, there has been this uptick in inflation expectations, but we still see the central bank as doing, the best job it can to try and anchor expectations, and as is its mandate. We can talk a little bit later if people are interested on fiscal dominance. We don't yet think Brazil is in an extreme state of fiscal dominance where the central bank tightening policies has the opposite effect that's intended by worsening the fiscal situation and making people want to hold dollars instead of reais, and then adding to inflation. But maybe the fiscal situation is rendering central bank policy somewhat less effective in stabilizing expectations and anchoring confidence than would be the case, if the fiscal situation were entirely under control. So as a result of a lot of these other factors, good, prudent central bank policy has involved Brazil having one of the highest real interest rates in the world. That's probably something that's well known to everyone on this call. In this chart, you can see that there is one country that has a higher real interest rate than Brazil right now, and that's Russia, which is facing very different political and economic circumstances than Brazil. So I think the fact that Brazil needs to have such a high real interest rate, it's still a bit of a mystery to a lot of people, how interest rates can be so high in Brazil and how the economy can keep growing with such high interest rates. And I think the simplest answer is it's needed to just offset a lot of other risk and uncertainty, perhaps on the fiscal front. And then the other great strength of Brazil is its external finances. Brazil has a very manageable current account deficit of about 3% of GDP last year. That was an increase from 2023, but due to a very strong growth, but still a very manageable number. I think the composition of Brazil's current account deficit has even gotten better. Brazil is now a country that runs a trade surplus, and a very large one at that. And what's somewhat offset that is this orange bar on the left, the income account, which is pretty much just the money that foreign companies are earning in Brazil, or money that Brazil has to send abroad on its interest payments. And that deficit has grown, but it's a reflection of foreign companies having invested in Brazil and bet on the country and making quite a bit of money in Brazil. And so it's not necessarily money that's leaving the economy. It's money that is being earned by foreign companies. But I wanted to highlight that even though Brazil might have the same current account deficit as it had in some prior years, the fact that there's a bigger trade surplus being offset by a bigger deficit in the income account is probably a good composition to have. And then the fact that Brazil has a lot of FDI that almost fully covers the current account deficit is another big strength, where Brazil compares favorably to other emerging markets. And then, I wouldn't call this a weakness, but a source of volatility is the fact that Brazil has a very open capital account in financial sector. So that means that despite all of these favorable trends in external finances, Brazil's currency is very sensitive to movements of money. And as we saw last year, in December alone, there was the biggest capital outflows from Brazil since the beginning of the pandemic in 2020, triggered by the fiscal announcements and concerns around the fiscal situation. Mostly non-resident, foreigners taking their money out of Brazil, but a significant contribution of Brazilians moving their money into dollars as well. So that is a strength, we think, Brazil's open capital account. It makes it attractive as a place to invest, but of course is a source of vulnerability and volatility for the currency. And then Brazil's final great strength, just how much reserves it has. As a share of imports, Brazil has a very high stock of reserves, central bank reserves. It's one of the highest among emerging markets, and it's the highest of a country that doesn't have investment grade on this list on the left. This middle chart shows that Brazil has more reserves than it does in government external debt. And that's actually a variable where you can see a strong correlation. Most countries that have investment grade have very, strong sovereign net foreign asset position, more reserves and sovereign wealth funds than external debt. And Brazil is one of the few countries without investment grade that does have a positive sovereign net foreign asset position. But then the final chart on the right shows that as a share of the money supply, Brazil does not have a very large stock of international reserves. And that's a reflection of something good, is that Brazil has a very deep financial penetration. It's a very deep financial market. So there's a very large money supply in Brazil. But that also means that if there were to be a confidence crisis in Brazil, it would not take very much capital flight. It would only take a little capital flight of that very large stock of reais, to completely deplete the central bank reserves if the central bank reserves wanted to fight against that capital flight. And China has an even lower variable of how much it has in reserves as a share of the money supply, but China has a very closed capital account. So once again, this is probably the main source of volatility in Brazil is not anything on commodity prices necessarily. It's more about confidence and the flow of capital. And then the last thing I'd say that's still a strength and a weakness for Brazil is politics. This is something we look at quite closely. It's a hard thing to measure, governance and institutionality, but Brazil's score has fallen quite a bit on these indices that the central bank produces of political stability, the effectiveness of the government, control of corruption, and that's something we use as the most objective source that we can find to try to measure governance. But of course, we do our own analysis of governance and don't just use these indices. And I think in Brazil, we see strengths and weaknesses. On one hand, Brazil has very robust checks and balances compared to a lot of other emerging markets. It has, a lot of checks and balances between the three branches of government. The judiciary is very strong here, and has a lot of autonomy. The legislature, is not just a rubber stamp, as we say, for the executive. There's other institutions like the TCU that, ensure integrity in fiscal accounting, and things like that. But on the other side, we do see that Brazil has a lot of political fragmentation, party fragmentation, which, on one hand has not precluded Brazil from achieving a lot of important reforms, as I showed on the list a few slides ago. But it usually ends up in reforms getting passed a lot later than the government anticipates, and with maybe a high degree of dilution relative to what the initial expectations are. So I'm sort of stealing a metaphor from ARCO advice, Brazil political risk entity, when they say that politics in Brazil is sort of like getting an Uber in the rain, where you're probably going to be able to find one, but you just might be waiting a lot longer than you otherwise would, and it might cost a lot more. You might have to make some concessions, and it might cost a lot more than what it otherwise would. But then finally getting to the last part of the presentation, which is the weakness for Brazil, it's the public finances. So here, red is where a variable is worse and green is where a variable is better. And Brazil, and these are 2025 forecasts, we're projecting Brazil's going to have the biggest fiscal deficit of all of the major emerging markets in the world. And this is just an abbreviated list of some of the very large sovereigns that we cover. The biggest fiscal deficit, we're projecting that it's going to surpass India to have the biggest debt to GDP ratio. And then interest to revenues, 20.8%. That's not the highest in the world. It's second to India and Egypt, at a very much lower rating level, Egypt, but is another variable where Brazil compares pretty poorly. But of course, Brazil's great strength is that it despite having so much need to borrow, it doesn't need to borrow from global markets, thanks to a very deep and reliable local capital market. It can fund itself in local currency almost entirely, but it does pay a price for that. If Brazil has opted to borrow locally and to do so at much higher real interest rates than it probably could get on dollar funding. So everything's related here. That because Brazil has lower foreign currency debt, that's one of the reasons why it pays so much more in interest, as you can see in the third column. So just getting into how we see the fiscal situation, in our view, the government has chosen, we're encouraged that the government is working towards fiscal consolidation, but in our view, it's chosen a pretty risky strategy to achieve that, which is in the first year, let the fiscal situation get a lot worse to attend to some social needs, but then as the next elections approach, try to tighten the belt. Usually in most countries, it's easier to have tight fiscal policy right after election in the honeymoon period. And then, there'd be more pressure to loosen the purse strings approaching elections. But in Brazil, we're seeing the opposite. And we think, Brazil is trying to aim for fiscal consolidation before the next elections, and that could be politically difficult. We think it's a politically risky strategy. Also, as you can see here, yes, the deficit, and these are preliminary numbers for 2024, did improve dramatically from 2023. But there was a lot of kind of timing issues with the precatorio payments, which is one of the reasons why 2023's deficit was so high. There was prepayment of some of the precatorio payments for 2024. There was some, issues regarding SOE dividends and other revenues and their timing. So net of all of those things, there wasn't a massive improvement in Brazil's fiscal situation last year, as you can see by this dotted line and the arrow, and that there's, still a significant effort that's needed in structural terms for the government to get from maybe a structural deficit of around 1% of GDP towards a balance in the coming years. And the strategy the government's chosen is very much about revenues rather than spending. As you can see here, spending rose dramatically in the first year of the government, and it fell last year, but it's still quite a bit higher than it was in 2022. And in the coming years, the consolidation strategy is mostly about improving revenues. For the next few years, there's very small contribution in our calculation from spending restraint. And even that could be difficult. The fiscal framework's not targeting major spending cuts. It's only targeting restraint in spending. But we think even that could be quite difficult. So starting with the revenues, here are the projections from Treasury of what's needed for them to achieve their fiscal targets. And as you can see in 2023, big fall in tax revenues, maybe in part due to lower commodity prices and some cyclical factors, and a decent improvement in 2024. But I think the issue in 2024 is that while the government did do a lot of measures in 2023 that helped tax revenues, like changes to the subsidy on the ICMS and changes in the CARF legislation, many other small measures that helped the revenue picture, and revenues were quite strong last year. The Independent Fiscal Institute measures that there was a significant contribution from just extraordinary revenues last year, revenues that can't be relied upon to arrive every year, mainly dividends, anticipation of dividends from state-owned companies and the like. So, given that, Brazil still needs a major fiscal effort going forward on the revenue side, just to keep revenue stable and to offset those non-recurrent revenues. And I think the challenge we're seeing is that the government is facing maybe a point of tax reform fatigue with Congress, which does not want to approve tax hikes. And it's proving very difficult to pass reforms that very convincingly improve the revenue burden. We only see very little things that change tax exemptions or are administrative measures that it's hard for us to have much confidence in because they're so complicated and specific. So it's difficult for us to see the government achieving further structural improvements in revenues going forward, with the composition of Congress we've seen. And on the chart on the right, you can see that Brazil already has one of the tax burdens that's the highest among major emerging markets, second only in this chart to Poland. And we do see that potentially there could be some room for Brazil to raise tax revenues without hurting competitiveness. There's a lot of tax exemptions in Brazil that maybe could be addressed, and that wouldn't, dramatically alter Brazil's competitiveness landscape. But, probably at the end of the day, over a long period, the consolidation path that Brazil needs probably has to rely more on spending cuts than revenue increases to avoid exacerbating this competitiveness problem for Brazil. And then on the fiscal rule and spending, the fiscal rule, as I said, doesn't really require spending cuts. It only limits the growth of spending. And as you see in this chart, I've separated the precatorio payments from other spending, since they're a large reason why spending fell last year. But net of those spending, didn't see a significant reduction. Brazil doesn't really, in the next few years, the fiscal rule doesn't really require significant reductions in spending as a share of GDP if they're going to be growing at the limit of 2.5% that's allowed by the fiscal rule. Now, that said, even that could be difficult because, you know, almost 95% of Brazil's budget now is mandatory spending that is very difficult for the government to control. The share of discretionary spending is what it needs to rely on to comply with the spending cap. And it's becoming, you know, increasingly thin. So even meeting the 2.5% limit in coming years, we think could be difficult. You know, we saw the fiscal package last year that the government announced, you know, that was the source of a lot of volatility at the end of the year, I think because it disappointed a lot of people in the eyes of the market. But you know, it's a good thing at the end of the day because we think it extends the expiration date of the fiscal rule by a few years. You know, without that spending package, mandatory spending would have completely squeezed out discretionary spending and made the fiscal rule unviable, potentially by 2026 or 2027. I'm using this threshold that the Independent Fiscal Institute says of 0.7% of GDP. That's the minimum that free discretionary spending needs to be before the government really can't function anymore. And, you know, previously that was set to, they were set to breach that lower limit by 2027, and maybe now it's a few years later. So we see, you know, we view that attempt positively. You know, it doesn't make the fiscal rule workable forever, but maybe makes it workable for a few more years. But there are still risks. And I think in this chart in the middle, we see that in 2018 through, you know, 2020, Brazil's spending was surprising on the downside. Pensions were costing less than what the budget had projected. But in recent years, we've seen that pensions are costing more than the government's initially projecting, and so are other social benefits like abono salarial and the BPC. So if this trend continues, then that date by which discretionary spending is completely squeezed out is going to be sooner. And then the last point is that, you know, Brazil's fiscal framework is entirely focused on the primary balance. Most emerging markets, though, look at the total fiscal balance because that's what determines debt dynamics. And Brazil has one, you know, Brazil's fiscal framework just sort of treats interest payments as a completely exogenous variable that they grow and fall as a function of monetary policy, and therefore, you know, shouldn't be part of the fiscal framework. But that also means that if interest costs get a lot higher, the fiscal rule doesn't require any offsetting effort in the primary balance to keep debt dynamics under control. So that's sort of the challenge we're seeing now, is that with tighter monetary policy, interest costs are going to rise to a very high level for Brazil. And there's no indication that there's going to be tighter fiscal policy in terms of the primary balance to try to offset that bad news. So at the end of the day, this means Brazil has debt that's going to rise quite quickly in the coming years. You know, when we upgraded Brazil in 2023, you'll see in this orange line, we did expect debt to GDP to rise, but that trajectory is quite a bit worse than we projected at that time. That said, the trajectory of debt to GDP, this red line, is lower than the green line. The green line is what we projected in 2018 when Brazil was downgraded to BB-. So, you know, we're still a number of years away before Brazil would breach the 90% threshold, which is where we thought it would be in 2018 when we downgraded Brazil. So, you know, the debt picture is still a lot better than we thought at that time, but it's mostly due to a better starting point, whereas the upward trajectory, the pace at which debt is increasing, is about as bad as we expected in 2018. And as you'll see in this chart on the right, Brazil's debt to GDP is very sensitive to correlated risks. If growth were to fall, that would maybe affect the government's ability to meet the primary balance, and that could create more, could undermine confidence and require the central bank to have tighter policy. All of those variables would be working against debt dynamics, as you can see in this line on the right. And I think perhaps the biggest challenge for Brazil's rating in tying everything together is that even though growth has surprised us positively, it almost seems as if strong growth does not help the public finances very much, or even hurts them in some way, because when growth is strong, that helps government revenues, but it also requires there to be more spending because of all the indexation and earmarking there is. And it also requires the central bank to have tighter monetary policy, which means higher interest costs. So every time we review Brazil's rating, we're usually revising up growth projections, but we keep having to revise up our projections for debt to GDP. And in most countries, it would be the opposite. If growth is better than we expect, the debt story would be better as well. And just ending the presentation, this is the main challenge for Brazil because Brazil has a high debt level. We think it's a manageable debt level. Brazil has very deep capital markets, and a part of its debt is the repos or the compromissadas of the central bank, which, other central banks have their own instruments with which they do monetary policy. So Brazil's debt to GDP ratio is a little higher than it otherwise would be because the central bank uses government securities to do monetary policy. If you were to strip those out, Brazil's debt is not so high, but it is high. And more importantly for us, I think then the level is the trend. We're projecting Brazil is going to have the debt to GDP that's the highest of any major emerging market in the world, beating India. So what could this mean for the rating? And I'll end here. Brazil's rating, starting maybe with the negative side, if we see kind of this negative scenario pan out where there's some negative growth surprise or some negative fiscal surprise that doesn't have to do with growth disappointment, that could further undermine market confidence, lead to higher interest rates, potentially further weaken growth. It's sort of a vicious cycle that could put Brazil's debt trajectory on a faster upward path, and that could lead to a downgrade. We currently have a stable outlook, and we think Brazil's rating has some room for resistance for debt to keep rising without it jeopardizing the rating. But eventually, if it were to reach very high levels closer to 90% without signs of eventual stabilization, that could put downward pressure on Brazil's rating again. But there could be a positive scenario as well. If there's good fiscal signals in the coming years, maybe before upcoming elections, but certainly after upcoming elections, there might be a greater window for those that help improve market confidence, allow the central bank to loosen policy, and signs of structural improvement in the underlying primary balance. All of that could be a virtuous cycle that gives us greater confidence that maybe Brazil could eventually stabilize debt, even at a high level, but on a stable trajectory, and that could get Brazil to a BB+ rating. But then finally, answering the main question we get, which is what could take Brazil to investment grade? And here I'm showing the current list of countries in the BB category where Brazil sits, and then the BBB category, which would be investment grade. Brazil stands out in the BB category as the only very large emerging market besides South Africa that doesn't have investment grade. Other ones like Mexico, Philippines, India, Indonesia all have investment grade. So what would it take for Brazil to get 2 notches higher and get investment grade? It would take stronger growth. And here I'm showing variables in 2013 when Brazil achieved investment grade and where they are now. I think we want greater confidence that Brazil is a country that can grow at 3% rather than this 2%, which may be possible given all the reforms we've seen, but I think we'll have better sense of that over the course of time in coming years. So confidence that Brazil is a more dynamic economy that would lift per capita GDP, which is an important variable for us. And then, of course, just much better public finances. We want to see a much lower fiscal deficit consistent with not only debt to GDP stabilizing, but starting to fall back to the levels that it was in 2013, a lower interest bill. And then the last thing I would say is this green area, which is in a qualitative sense, we want to see not only the variables improve, but we want to have a qualitative sense that there's political consensus around these policies that Brazil used to have. There used to be the tripe of inflation targeting and a flexible exchange rate and a primary surplus. I think we want greater confidence that there's political consensus around those policies that wouldn't change over election cycles. So I think that's something Brazil lost when it lost investment grade. and could take some time to recover. So I'll leave it there, and we can go to Q&A.
Yeah. Thanks, Todd. Congratulations for the presentations. Really, very, very good content, and we see how many ratios and index you take into consideration. It's hard really to achieve this, but again, we have here open the chat, so please feel free to add questions in English or Portuguese. We address to Todd. I may start myself here to help Todd. You mentioned about this connection with the global situation, the economies, and all this dynamic today. Although Brazil doesn't require, as you said, any financing, but we are hard to decouple from everything that is happening in the international scenario. But there's something new, which is the Trump's administration, which just came through. Although starting, do you see any main channels of risk in terms of this new Trump's administration that could affect Brazil?
Mm-hmm. Yeah, this is a question we're obviously looking into closely for all of Latin America. And we've identified maybe like 5 channels of risk coming from the Trump administration, and we've done some work, and Brazil is not one of the countries that's standing out as most vulnerable. That's obviously going to be Mexico. But we do see some relevant channels of risk coming to Brazil that are worth watching. So those channels are tariffs, migration issues, which really are irrelevant for Brazil. It's more relevant for Mexico and Central America. Kind of Chinese investment getting discouraged, which is maybe, China's maybe a relevant actor in Brazil, but not nearly as important as it is in Peru or Argentina. So I won't talk much about that. Fed policy, this is something where I think it's maybe the most relevant channel for Brazil. And then, kind of political dynamics with the Trump administration. So on tariffs, Brazil is a fairly closed economy. It doesn't have very high exports as a share of GDP. And its main trading partner is China rather than the US. But Brazil does, export, certain sectors and some sectors with higher value added, in the manufacturing sector, do count on the US as an important market. So if there were to be some 25% tariff on Brazil, that probably wouldn't lead us to be revising our growth projections for Brazil in a negative direction like we certainly would in Mexico. But it could be meaningful for some certain sectors. And, maybe there would be pressure on the government to provide some assistance to those sectors. Confidence in Brazil is very volatile, so that, might also affect that and have secondary effects. So it's not one of the countries that worries us the most in terms of potential tariffs, but we don't think it's a risk worth discounting entirely. Maybe the more relevant channel for us is Fed policy and global financial conditions. We think the Trump administration's economic policy is inflationary. Higher tariffs could put pressure on American prices, and a more expansionary fiscal position, especially if there's tax cuts in the US, would, not only maybe require the Fed to stay tighter for longer, but also means greater US fiscal deficits in the future that mean greater supply of US treasuries that could put more upward pressure on the higher end of the yield curve in the US. So all of those are variables that could matter for Brazil. I think Brazil's domestic interest rate situation has much more to do with domestic factors and the fiscal issues I talked about. But certainly if there were a scenario of the Fed needing to hike again, which is not our baseline, but or the Fed needing to stay much tighter for longer, or other things that just put further pressure on the longer end of the yield curve, that could just be an additional thing that makes the job of Brazil's central bank, significantly harder. And then politics is sort of a risk factor that we highlight where there could be a lot of surprises. There's a government of the right in the US now, and in Brazil, there's a government of the left. Our baseline is that, that a lot of these countries in Brazil's situation will find a way to live with the US government perfectly fine. But as we saw in Colombia, which has a government from the left, or even in Panama, which has a government from the right, there's kind of these unexpected surprises coming out of the Trump administration that could have meaningful consequences for confidence. So not predicting anything specific here, but it's just something we're keeping a close eye on.
Well, thank you. I agree. We have to hope that we see opportunities as well here, because as you see, tariffs are being applied as a threat or expectations in most of the commercial relations. So Brazil could have an opportunity to establish a Mercosur with some trading that will replace those bigger or higher tariffs with the US. So I hope that we see some opportunities and think about that as well. I think there can be an upsides here. I agree with that. I may follow another one here that I believe it's important, and about the comparing country risk with corporate risks, companies that operate in Brazil. I remember when I was CFO of Embraer. Embraer had the rating which is higher than the sovereign rating, and we were capped by that. That was just an example, but we may find several corporations in Brazil that has ratings which can be better or higher than the sovereign rating. So, but it has a ceiling here that establishes capping this. So how you determine that? How you see capping or the ceiling country ceiling risk that could affect companies, especially companies that may access international markets for financing, which is definitely that. And also, if you have some exceptions for that, is that possible to have? How you see this?
Yeah, so I didn't talk about the country ceiling in my presentation, but that's kind of the other major rating that we assign to every country. We assign the sovereign rating, and we do a sovereign rating in foreign currency and local currency. Sometimes they can be different, which is rare. But we also assign the country ceiling, which is what is the maximum rating of corporates within that country, were they to try to tap global capital markets. And it's sort of hard to explain because we need to get into a hypothetical situation. But the country ceiling is essentially trying to say that even the best managed corporates that have much better finances than the government of a country could be at risk if the government were to have fall into a situation of stress and need to restructure its debt. Or if the government were to default, even a very well-managed company could be at risk if that government, to try to help itself, were to impose restrictions on transfer and convertibility, the private sector's ability to access dollars. In some very stressed sovereigns, that's something we see, that when the government is falling into stress, like in neighboring Bolivia right now, the availability of dollars to the corporate sector is being limited. The central bank no longer has dollars to sell to the private sector because it needs those dollars for itself. It might change regulatory rules to force companies to bring money home. So, even at very high rating levels where that's not really a scenario we're worried about, we still have to think hypothetically and say, okay, if the sovereign were to fall into a situation of distress, does it have incentives to pose capital controls on the private sector? And if the answer is yes, then the country ceiling shouldn't be higher than the sovereign, or maybe is only a little higher than the sovereign. And what can get the country ceiling much higher than the sovereign when we go through that hypothetical exercise? Well, if a country has a lot of free trade agreements, that's helpful, because free trade agreements kind of are a promise and with other countries that they won't kind of do transfer and convertibility restrictions or seize dollars from the private sector. That there's certain commitments to the free movement of capital when you sign a free trade agreement. And also we just look at how much capital controls currently exist, or how open the capital account currently is. So I think on one hand, Brazil doesn't have many FTAs. It's a pretty closed economy. So that's something in our model that's not helping Brazil's country ceiling variable much. But on the other hand, it has a very open capital account. And this does seem to be internalized as an important part of Brazil's economic model, is to let there be free movement of capital. And, the Brazilian real, has made a lot of strides toward becoming a fully convertible currency. So that's something that gets Brazil one notch above the sovereign. But to get multiple notches above the sovereign, that's something that could happen based on our model. Probably the best news would be if there were more bilateral investment treaties and foreign trade agreements that kind of restricts the government ability to impose capital controls in any event of stress.
Okay. I think we have a last question here. I'm taking the audience here. José Luis question here. What is Fitch's opinion about the consumption tax reform?
Mm-hmm.
You mentioned that, but I don't know if how
Sure thing.
We can do this now. Yeah.
Yeah, and before I forget, one thing on the country ceiling, that limits the corporate ratings, but corporates can go above the country ceiling if they have a lot of foreign operations and assets. So I did want to mention that there are many world-class Brazilian companies who some are limited by the country ceiling, but some are above because they have so much dollars abroad, they're less vulnerable to transfer and convertibility risk. And I think Embraer, as you mentioned, might be an example of that with its now investment grade rating. On the consumption tax reform, I think we have a very positive view of this, but it's not something that has led us to revise up our growth projections yet. But the positive view is, I think this is a testament to the fact that even though Brazil has political challenges, it's one of the few emerging markets in Latin America that's really achieving some important legislation. This is without a doubt one of Brazil's main competitiveness issues, is how complicated the tax system is, and the fact that Brazil got this reform passed, still in the final stages. I think speaks well of Brazil's political environment. Even though it did result in some dilution of the bill. So we think it speaks well to governability, and it's certainly an upside for growth over the very long term, because Brazil is focusing exactly on the things that are holding growth back. Also, we think it's a good example of that, even though this is a government from the left that is trying to is talking about a very different economic growth model than the prior Bolsonaro government. At the end of the day, in microeconomic terms, it has not sought a radical deviation. It's pursuing a consumption tax form, which we think is very market friendly at the end of the day. So we view it positively in that sense as well, as a sign of microeconomic policy continuity with prior governments rather than disruption. That said, in terms of growth, there's a very long transition period on this reform, and I think there's still a lot of details that need to get ironed out. And at least for the next 5 years or so, there's going to be a very complicated old system that is getting replaced by the new system, but it still exists. And so you're probably going to have a more complicated tax system for the next 5 years as this transition occurs, rather than a simpler one. So we're not entirely convinced this is something that's going to lead investment to take off in the next few years. But maybe there could be a good signaling effect, of Brazil getting to a simpler tax system in the long run that could convince some corporates to start investing more now. So it's something we don't think has an immediate effect, but we don't rule that out, and certainly see this overall as a big upside for Brazil.
Thanks, Todd. I think we are running out of time here, but thanks for that. And João, I will turn back to you.
Oh, thank you. Todd, thank you very much. Great presentation, great conversation. Todo mundo que participou aqui conosco, muito obrigado. Eu queria até que a Elaine colocasse aí para nós o QR Code. Queria ouvir de vocês o feedback para que a gente continue aí trazendo outras oportunidades como essa. Obrigado a todos, tenham todos um bom dia. Thank you, Todd. Good morning, man.
Thank you, everyone. Muito obrigado.
Okay.